Very good morning to all of you students. Today we will be starting our discussion on interest rate risk management. So, students, to start with, on interest rate risk management, we first need to understand why is interest paid? What are the reasons for which we pay or receive an interest? So there are broadly two reasons, students. Good morning, Mansha, Shailesh, Viraj. Good morning, everyone. So there are broadly two reasons, students, why an interest is paid. I think this we have discussed earlier in our previous sessions. One is there is a risk of non-payment, correct? If there is a risk of non-payment, then the person who has lent the money will expect some return on account of taking that risk. Now, this non-payment is of what? Is it can be for the principal or it can be for the interest as well. So if the risk is high of non-payment from the borrower's side, the lender will expect higher interest, correct? Higher risk will mean higher interest. Similarly, lower risk will mean lower interest. Agreed? I hope all of you agree with me. Good morning, Satish Kumar. Yes, Viraj, interest is a reward for money invested or borrowed. That is perfect. Now, that reason for interest, the primary reason is risk, and another primary reason is the inflation. Or this we also call as time value of money. Now, what does inflation means? Inflation is actually from one year to another year, if the general prices of any commodity or any basket of goods increases such that the purchasing power of that currency goes down, that is termed as inflation. Or it is also in interest parlance, we also refer it as time value of money. Because 10 rupees today will not be equal to 10 rupees 1 year from today. It will be higher or it can be lower. Correct? Generally, it is higher. That is why we always call there is an inflation. So, let's say today, one basket of goods. Okay, and while I say one basket of goods, these are standard goods, right? Let's take some standard goods. So one basket of goods is equal to, let's say, rupees 100. This is as on today. And after 1 year, the same basket will be, let's say, 120. Okay. So hence, there is a 20% increase in the value of the similar goods. So that means inflation is 20%. To cover up for this loss in the value of money, the interest is charged, because now while charging the interest, the lender will say that 20% I have lost on account of inflation. So you need to pay me that. Plus another 5% I want for risk that I am undertaking. So let's say 20% here and another 5% here. So in totality, 25% will be charged by the lender, students. I hope the understanding of why interest is paid is clear till now. Yeah. So This is clear. Now, the risk of non-payment is generally denoted by certain credit rating agencies, right? Because how will you quantify that risk? How will you quantify that risk? Or is there a objective assessment of the borrower's capability to pay it back? That is happening from credit rating agencies. So they will do the credit rating accordingly. It will be mentioned that whether the credit capability of the borrower is good, bad, or very good. Okay. And inflation is generally the macroeconomic factor which is reflected by each and every country. Now, with this, we understand that interest is dynamic, students. Interest rates are dynamic, correct? These are not static. These will not remain same. These are bound to change. Bound to change on account of multiple factors, on account of market forces. Let's say there is a supply of money, there is a demand of money. And if the supply of money is higher compared to the demand of money, the interest rates will go down. Correct? Similarly, the demand of money is higher. People are seeking more loans. People are, people are expanding their businesses. They want higher loans. So in that case, the demand of money will go up and hence it will increase the interest rates. Okay, so then there is a market factors that impacts the interest rates. Plus, in India, in Indian context, RBI is also authorized to change some of these interest rates. You would have seen in their policies that they notify different interest rates or they notify the changes to the interest rates. Okay. Kirti, good morning. Viraj, it is clear. Okay, perfect. Now, with this, if interest rates are dynamic, students, and you can imagine today any company is not isolated from the interest rates impact because either they will have borrowings or if they don't have borrowings, they will at least have investments. So from both the sides, from their liability side as well as asset side, they are exposed to the changes in the interest rates. Correct? And hence, their P&L is also impacted because of these interest rate changes. Correct? So what I'm trying to say is that any change in the interest will have an impact on the financials of the company, more specifically on the interest income and interest expenses. Correct? Agreed? Till now, agreed, students? So, in this entire topic, we are going to study some of the techniques by which the impact of the interest rate changes on the financials can be avoided to some extent. Okay, that is called as interest rate risk management because we are trying to manage the interest rate risks. So what is the interest rate risk? First of all, students, interest rate risk is actually changes in interest rates. These are the changes in interest rates. What are they? One is inflation and second is risk. Correct? So because of these, the changes will happen. And as I told that these will impact the financials. So interest rate changes impacts financials of the company. And this is true for any company, students. You imagine there is a bank, you imagine there is an insurance company, you imagine there is a manufacturing company, you imagine any service industry also. Either they would have taken some borrowings or they would have invested somewhere, right? So this is a very inherent risk in the company's financial statements. Okay. Now let us so I think the problem statement is clear, right? What is the problem statement and what are we trying to define? Now let's come to the techniques by which we can hedge the interest rate risk, students. By hedging, I hope now the term hedging is clear, right? In derivatives as well, we discussed hedging is the protection to the buyer or seller against the opposite movement of any index. In this case, that is interest. Okay. So hedging interest rate risk. Good morning, Prashant. Viraj Shailesh, thanks. Mancha, we will not go to the, let's say, economic theories. We will we will now link it to the very practical aspects that we have. So this is a very interesting topic, students. Okay, because this is a very practical aspect. Now we will discuss them. So hedging interest rate risk, students, there are two broad categories. First of all, one is the traditional method, and second is the modern method. In case of a traditional method, students, there are assets and liabilities in place, and hence there is a method called asset and liability method, ALM. Asset, okay, let me write it full. The first method is asset and liability method, which is also called as ALM method. And second is forward rate agreements. This is called as FRA, forward rate agreements. Modern methods are three. One is interest rate futures. Second is interest rate guarantees. Then last is swaps. These are more specifically interest rate swaps. Okay, students. So we will discuss all these five methods in detail. Out of them, four methods, we have very much practical questions, except for this asset and liability method, which is a very simple method. We just need to understand this. Okay. Now let's start, students. The first method is asset and liability method. So students, this is a very important thing that is done or ensured in any of the treasury departments of any company. Because what happens, the underlying of interest cost or interest income is your liability or asset respectively, right? Sorry. Now, imagine that you have pool of assets and pool of liabilities in your balance sheet. Now, some of them liabilities are getting matured before that asset is getting matured. So that means you have to pay for that liability before you realize your asset, because your asset will get realized, let's say, after 6 months. Your liability has to be paid after 3 months. So in this case, what will happen? After 3 months, once your liability needs to be paid, you need to incur a fresh liability for another 3 months. Then only after 6 months, whenever you will get your asset back, you will repay your second liability, right? That's how it will happen. So asset liability method is actually matching the maturities of your assets and liabilities in such a way that we are not exposed to any risk on account of reinvestment risks or on account of taking fresh borrowings risks. That is at the rate of fresh interest rates, students. So this is more to do with the timing of cash inflows and cash outflows. This essentially is achieved by matching the assets maturity with the liability maturity. Clear, students? So, in a way, the assets maturity is matched with the liabilities maturity to make sure that there is no fresh interest rates at the new rates being incurred, right? As I told you. Yes, Shailesh, in a way you can say that, because in that you are parking funds for temporary basis, then again you are borrowing funds for temporary basis. So you can say that, okay? Okay, students, let's move ahead. So this is it. I mean, you can go through the theory, right? That is there. Now let's come to our main agenda, which is the forward rate agreement, students. One more thing, student, this ALM method is very much relevant for NBFCs, for banks, because they have to publish their ALM reports also, right? Which includes, let's say, the maturity profiles of their assets and liabilities. Okay. So yes, students, now coming to forward rate agreements. Now hear me out, students. So all of us know that there is a interbank market, correct? What do I mean by interbank market? Where banks are lending the money or borrowing the money within themselves, correct? That is called as interbank market, in which a retail investor or a retail borrower is not allowed to participate. The classic example is Mumbai Interbank offered rate, which is MIBOR, which is the rate which appears for all the banks who are operating in this market. So there is an interbank market, right, where different interest rates appears and wherein, let's say, different banks are operating. Now let's take an example, let's say, of two banks, Bank A and Bank B. So there are two banks in the same market that they are entering. Now what does Bank A needs? Bank A needs to borrow after 1 month. So bank A does not needs to borrow today. Bank A needs to borrow after 1 month for 3 months. Rupees 1 lakh. Okay, students? Clear? The requirement of bank A is clear. Bank A wants to borrow after 1 month from today an amount of rupees 1 lakh, and the timing they need to borrow is other, let's say the duration they need to borrow is for the 3 months. Bank B needs to invest for 3 months after 1 month, rupees 1 lakh. Now, Bank B on the similar side needs to invest, but not today. After 1 month, it needs to invest. And the duration is also 3 months. And the amount is also similarly 1 lakh. Okay. So now both the positions are clear for these banks, students. Now, there is some additional thing that we need to understand is that current interest rates are at, let's say, 5% per annum. But for this transaction, do you think that current interest rate matters? No. Why? Because we are not talking about doing this transaction today. We are talking about doing this transaction of lending or borrowing 1 month from now. So, which essentially means that we need to also take into account what is our forward interest rate, students. Forward interest rate is 6% per annum. And this is for 1 month from now. 1 month from today, if somebody wants to borrow or lend, it will be 6% per annum. Okay. So it's just like in our derivatives, we studied that what is the current price of the equity? What is the forward price of that equity? Okay. So if I just plot it, so this is 0 month, this is 1 month. We are standing here on the 0th month. So from 0th to first month, there is no transaction that is going to happen because ultimately at the end of the first month, we have to initiate a transaction and then we have to borrow for 3 months. That means we will reach to the fourth month, correct? And here the borrowing will happen basis 6% per annum rate, which is the forward interest rate appearing as on 0th month for the first month. You're agreeing, students, till now? I hope this is clear, students, till now. So this is actually the duration is 3 months. Correct. So the duration is 3 months. 4 month we will end. First month is this. So then ultimately we are talking about of FRA 1/4. So this is denoted by forward rate agreement of 1/4. So this entire arrangement between bank A and bank B, because bank A, what they will say is that after 1 month, for 3 months, I will borrow from you rupees 1 lakh. Bank B is telling to bank A, okay, after 1 month, for 3 months, I will lend you rupees 1 lakh. So this deal happened. Deal happened at 6% per annum because this will also get fixed today. So even the rate at which they are entering, even the rate at which they would be entering after 1 month is fixed today, which is basis this forward interest rate 6% per annum. And it will be denoted through this notation, which is FRA 1/4. So one is actually the starting period of that loan, or let's say investment. So in this case, first month it is starting. Then you add the duration of that loan and arrive at the ending month. So which is fourth. So 4 means 4 minus 1 is equal to 3 months. Correct? Which is the duration. I hope it is agreed. It is understood, students. Now tell me, what does this FRA mean? In this, when loan will start and what is the duration of loans? Tell me, students, these two things. For FRA 3 by 6, the notion when the loan will start and what will be the duration of that loan, students. Come on, students, tell me. You can reply on your query handle. Perfect. I got a lot of answers. Shailesh, third month, 3 month duration. Perfect. Gurram, loan will start after third month for 3 months. Very good. Mansha, after 3 month duration, 3 months. Perfect. Prashant, 3 month, 3 month. Perfect. Very nice, students. So loan will start after 3 months and the duration will also be for 3 months. Now let's talk about a FRA of 12 by 24. Or let's say, let me take 12 by 18. So loan will start after 12 months, students, correct? And the duration will be 6 months. Okay? Yes, Kusuma, very good. Kumar Jyoti, you're right. Okay? So the notation is cleared. Now let's move ahead, students. Now, students, the commitment has happened from both the sides. What is the commitment? Bank A has committed to borrow rupees 1 lakh after 1 month for 3 months at the rate of 6% per annum. This is the commitment. From Bank B, what is the commitment? Bank B has committed to lend rupees 1 lakh after 1 month for 3 months at the rate of rupees 6 at the rate of 6% per annum. This is agreed on 0th period, which is today. Now, let's take an example. What actually happens on first period, on the first month, right? On the first month period, what happens? Let's put different cases. Okay. So the first case I am taking as, let's say 8%. Actual interest rate is 8%. So after 1 month, the actual interest rate comes out to be 8%. Students, tell me, who is the person which bank has gained and which bank has lost? Tell me, students, just apply the simple logic. For the existing arrangement of 6% per annum borrowing and lending between Bank A and Bank B, we come to know after 1 month, the actual interest rate is 8%. So whether Bank A has gained because of this commitment, Bank A has gained because of the commitment. Very good, Kusuma. Kusuma, you are right. Tell me, other students, what do you think? Who has gained and who has lost? Very good. Kirti, you are right. Satish Kumar, yes, you are right. Gurram, very good. You are also right. So, Bank A will gain 2% and Bank B will have a loss of 2%. Yes, Prashant, you're right. Very good. Now, why will Bank A gain? Now think it that Bank A has a commitment to borrow at 6%. The actual market rate is 8%. Bank A will say, see, because of this commitment, I'm able to gain 2%. If I am not borrowing from the market, I will borrow from this arrangement. Had I not done this arrangement, I would have paid 8% for 3 months borrowings of rupees 1 lakh. Correct? So hence bank A is saying because of this commitment, I had gained 2%. Now, case number two, actual interest rate is, let's say, 5.5. Now, if you see bank A, how bank A will think? Bank A is saying that I had a commitment to borrow at 6%. However, the actual market interest rate on the first period when we are executing this comes out to 5.5%. So that means I had incurred a loss of 0.5% because had I not done this commitment, I would have been able to borrow at 5.5. So there is a loss to bank 5.5, and here there is a gain. Sorry, the loss is 0.5, students. And here the gain is equal to 0.5%. Okay, students, I hope this is understood. Yes, Kirti, you're right. Yes, Mancha, you can call it that. Okay. Now, we also need to calculate, let's say, what are the payoffs for this entire transaction, right? For option one, or let's say the case one, what is going to be the payoffs between A and B? Bank A would get 2% and Bank B would pay 2%. Now, how will this get calculated? First of all, on 1 lakh, 8% minus 6% is what we are doing. 8% is the current market interest, and 6% is the market interest which we have agreed at the inception. What is the duration for this? 3 by 12. Whole divided by 1 plus 8% into 3 by 12. So this comes out to be 490.19. So with this division, what we are doing is actually we are bringing to the present value at the start of the loan. Present value at the start of loan. Correct, students? So you are saying at first month, what is the value of this gain or loss that bank A will get and bank B will pay to bank A, which is 490.19 students. Okay. Because generally the settlement of this gain or loss will happen on the day when the loan starts. Clear, students? This is a market accepted norm. Now on case 2, or let's say the option 2, where we are saying that it is 5.5%. Here bank A will lose 0.5% and bank B will gain 0.5% students. And how it will get calculated? 1 lakh multiplied by 6% minus 5.5% into 3 by 12 whole divided by 1 plus 5.5% into 3 by 12. So students, please remember this present value will always be taken at the actual interest rate appearing on the starting of the execution of loan. Okay. So this comes out to be 123.31 students. Now here bank A would pay 123.31 to bank B. Clear, students? So what I'm trying to say is that the settlement of this gain or loss will happen on the day when execution of the actual loan is happening, not when the commitment is made and not when the loan period gets over. Okay, it happens on the start of the actual loan given or taken, students. Clear? And the rate to do the present value or future value will be taken basis the actual interest rate. Okay. Now the formula is payoffs is equal to notional amount multiplied by RR minus FR into time period whole divided by 1 plus RR into time period. So here N is equal to the notional amount. RR is equal to the actual interest rate. And FR is equal to the forward rate. T was our time period, which was equal to our duration of the loan. So in our example, this was 1 lakh, correct? Actual interest rate, we have taken two examples, 8.5 and 5.5% students. Forward rate was agreed on the date of commitment itself, which was 6%. Time period duration was for 3 months. Ultimately, so this is the formula, students, correct? This is what we have applied. Ultimately, what we are doing is bank A, which is on a borrower side, and bank B, which is on a lending side. Okay. So for bank A, we say that bank A has purchased forward rate agreement. And similarly, bank B will be said to have sold forward rate agreement. This we call as long position. Okay. This we call as short position. Long position for FRA, short position for FRA. And in a way, the thumb rule here becomes if the interest goes up, bank A will gain. If the interest goes down, bank A's gain will also go down. Just now we have discussed, right? 8% interest had gone up. The gain to this bank had also gone up. Similarly, the interest had gone down to 5.5. There was a loss, or let's say the gain has gone down. Similarly, for bank B, which is on a short position, will have an inverse relationship to the interest rate, correct? If the interest rate goes up, the gain will go down. Here are we. Just giving 30 seconds to note it down, students. Now the notional amount became the actual borrowed money. Guram is asking, notional amount became the actual borrowed money. Then can we call borrowing money instead of notional amount? Yes, Guram. So notional amount is equal to the borrowed money. Why? Because to achieve a complete hedge, you will have to make sure that your notional amount is equal to the borrowed money. Question number 1. We are moving ahead to question number 1, students. Okay. Ankush Limited has a plan to raise an amount of rupees 50 crores for a period of 3 months. Now, please remember, students, Ankush Limited has to raise an amount. That means we are talking about Ankush Limited to be on the borrowing side. That means Ankush Limited will have to have a long position in FRA. Okay. Amount is 50 crores for a period of 3 months, 6 months from now. Tell me, students, how will I write this FRA? FRA, what into what I will do? So they are saying period for 3 months, 6 months from now. Tell me. I request all of you to answer, please. This is FRA of what and what? FRA dash into dash. Complete this dash. Guram, please check once. Kusuma, you are right. Yes, students, please answer. Request others also to please answer. Mansha, Shailesh, please check again, students. Prashant, you are right. So Prashant and Kusuma, both of you are right. Please read it again. Ankush Limited has a plan to raise an amount of rupees 50 crores for a period of 3 months, 6 months from now. What is the duration? 3 months. When this transaction is going to start after 6 months. So our first value is 6. And on this 6, yes, Gurram, now you are correct. Kumar Jyoti, no, that is not correct. Prashant, Gurram, Kusuma, all three of you are correct now. Okay, so this is 6 by 9. No, Shailesh, not that. It is 6 by 9. It can't be 6 by 3. So the duration we have to add in the initial period. Okay. The current rate of interest is 9%, but it may rise in the 6 months' time. The company wants to hedge itself against the increase in the interest rates. Bank of India has quoted a forward rate agreement at 9.1% per annum. Yes, Mansha, now it is correct. Now, the FRA being quoted is 9.1%. Sorry. Find the effect of FRA and actual interest cost to Ankush Limited if the actual rate after 6 months happens to be 9.5 or 8.5. So, first of all, they are saying that Ankush Limited has entered into a FRA. What is that FRA? FRA 6 by 9 and the interest rate is 9.1%. Okay. Now, after 6 months, the interest rate goes up to 9.5% and it goes down to 8.5%. Now they are asking us to calculate the impact. The moment it goes up, tell me, students, Ankush Limited will gain or lose? Case 1, which is given, let's say the actual interest rate is equal to 9.5%. Correct? If the actual interest rate is 9.5%, tell me, with this compared to 9.1, Ankush Limited will gain or lose? Yes, perfectly right. Mansha, Kusuma, Shailesh. Very good. So, Ankush Limited will gain. We have to calculate the amount of gain. For calculating the amount of gain, we will write our payoffs formula. Notional amount into, what was the formula? RR minus FR, which is the actual rate minus forward rate multiplied by T divided by 1 plus RR into T. Correct? So in this first case, what is the notional amount? Yes, Kirti and Gurram, you're correct. So what is the notional amount? 50 crores. 50 crores multiplied by 9.5% minus 9.1% into 3 by 12. The borrowing is for 3 months, correct? After 6 months, it will happen, but the duration will happen for 3 months, students. 1 plus 9.5% into 3 by 12, which is the actual rate basis which we will do the present value, students. So this comes as 9.5 minus 9.1, 0.4 percentage on 50 crores is actually 0.2 crore into 3 divided by 12. So this becomes 0.05 crores divided by 9.5 into 3 divided by 12. 1 plus. So this is 1.02375. Okay. So 0.05 divided by this number comes out to be 1 crore. So this is actually equal to 4,88,400. Yes, Prashant. So the payoffs will result into a gain. Payoffs is equal to 0. Now, in terms of lakhs, it is 4,88,400 as gain. Correct? Now, let's say the impact to Ankush Limited. So after 6 months, when it is actually going to borrow, it will end up paying 9.5% payment of interest at the rate of 9.5 percentage on 50 crores. Correct? Into 9.5 percentage for 3 months. So this becomes 1 crore 18 lakhs 75,000. Okay. So this is how much? 9.5% on 50 crores for 3 months. Correct? Minus gain on account of FRA. How much is that? 4 lakh 88,400 is the gain, students. 488 400. So net level it is 1 crore 13 lakh 86 600. 1 crore 13 lakh 86 600. Okay. So Kirti is saying, is it present value of gain after 6 months from now? Yes, Kirti, it is the present value after 6 months. So we have reached on that 6th month, and on that date we are doing this calculation, Kirti. Okay. Now, if you do this calculation, if you try to achieve the effective borrowing cost, which is 1 crore 13 lakh 86 600 divided by 50 crores multiplied by 12 by 3. Correct? For annualized number, you will get 9.10928 percentage, which is approx 9.1%, which is the FRA 6 by 9 rate. Correct? So hence it is proved that your ultimate borrowing cost will be fixed at 9.1%. That means you are hedged against the risk of actual interest rate going up. Okay. The actual interest rate has gone up to 9.5%. However, because you have entered into this FRA, still you are able to enjoy the borrowing at 9.1%, students. Yes, Mansha. After 6 months, we are calculating this. Clear? So we have calculated the payoffs and we have also shown the impact of this payoff on the effective borrowing cost for the company. Let's move next now. The second case is actual interest rate is how much? 8.5 now. Actual interest rate is 8.5%. Now, in this case, students, thank you, Satish. In this case, students, tell me whether Ankush Limited will gain or lose. Ankush Limited will have to do a additional payoff. How much? Payoffs will be 50 crores multiplied by 8.5% minus 9.1% into 3 by 12 whole divided by 1 plus 9.1% into 3 by 12. Sorry, not 9.1, it is 8.5 because this is going to be the actual rate. Okay. Yes, Kirti, you're right. Ankush Limited will lose. So this is the calculation. So 9.1 minus 8.5.6 into 50 crores into 3 divided by 12. 1 crore is actually 7,50,000 divided by 8.5 into 3 divided by 12. 1 plus. So this is 1.02125. So 7,50,000 divided by this is equal to 7,34,394. So the payoffs for Ankush Limited becomes 7,34,394 as a loss. So Gurram is saying in impact of interest, if we pay 9.5% interest, then what is the use of FRA? And gain loss is only for calculation of benefits. So Gurram, see, it's very much similar to your actual delivery. So in derivatives, we have studied that there are two ways to settle a derivative. Either you take actual delivery of that underlying or you settle the difference. And once you settle for the difference for the actual delivery, you go into the open market and sell it or receive it at the current rate. Do the transaction at the current rate, right? So in this case, to show the impact, what I have done is I have shown the delivery not being taken. That means the loan not being taken from the FRA point of view. Only the net settlement is happening and the loan is taken from the open market. Okay. But the use of FRA is significant. Had the FRA not been there, the open market interest rate is 9.5%. He would have ended up paying 1 crore 18 lakh 75,000 instead of now, which is 1 crore 13 lakh 86,600. This one. Okay. Yes, Kusuma and Mansha. 734, 394. Perfect. This is the payoff. Now let's calculate the impact on Ankush Limited. So first of all, Ankush Limited will pay interest at the rate of 8.5%. So 8.5% on 50 crores multiplied by 3 divided by 12. Correct? Just like similar to this. 50 crores into 8.5 percentage into 3 divided by 12 into 1 crore, which is 1 crore 62,000, 1 crore 6 lakh 25,000. Okay, then add the payoffs for FRA. So here this payoff needs to be paid, right? So 7,34,394. So 106, 25,000 plus 734, 394. 1,13,000, 59, 394. 59, 394. This is the total interest cost. Students, please do remember in this case we have to add, correct? Because it is a loss to Ankush Limited. So hence on the original interest, we have to add this payoff. Okay. Now this amount divided by now if we arrive at yes, Mansha, perfect. If we arrive at effective borrowing cost, this will be 1 crore 13 lakh 59 394 divided by 50 crores multiplied by 12 into 3. Multiplied by 12 divided by 3. This comes as 9.0875 percentage, or say 9.01 percentage approx. Okay. So in a way, the effective borrowing cost again has been restored to 9.01 because we have committed the rate of 9.01 percentage, students. So yes, Satish, you're right. It means FRA is a kind of derivative instrument. Yes, it is a derivative instrument wherein the just like it's a forwards, right? In forwards also you're committing yourself to purchase or sell a commodity or an underlying at that price in future. In this case, instead of that commodity or that underlying, the underlying is the interest rate. Okay. Sorry, it's not 9.01, it's 9.1 actually. Sorry, students. I mentioned it wrong. It's 9.1. Okay. Clear now? Let's move to the next one. Yes. Now, before this, we have to understand the interest rate futures, students. So FRA is till that one only. Okay. We also have to understand the pricing of FRA. Okay, let's first do the valuation of FRA. Then we will move to the interest rate futures. Okay. Yes. So now students, let's come to the valuation of FRA. Another important concept. I'm taking here an example of FRA 3 by 6, and let's say 5.25 percentage is the rate agreed for this FRA. 5.25 percentage is agreed for this FRA, students. Now 3 by 6 FRA will mean what? 0, 3 months, and the actual loan will be there till 6 months, right? From third month to 6 month duration is 3 months. Correct? Now students, if you know, okay, now the what are we trying to value here for FRA? The value we are trying to find out is what is this interest rate, right? For this 3 months to 6 months, and which is third month from now, what is the interest rate going to be? So let's assume to be X%. If we have the interest rate for the next 6 months, let's say it is 5%. And if we have the interest rate for the 3 months, let's say it is 4%, then can we find out this third month to 6 month interest rate? Yes, we can find out. We can simply say that 1 plus 5% for 6 months will be equal to 1 plus 4% for 3 months multiplied by 1 plus X% for next 3 months. I hope this equation is clear, students. In this, we are equating the 6 months interest to the 3 months, first 3 months multiplied by the next 3 months. So if you solve this, the X comes out to be 5.94 percentage. This is also called as theoretical minimum value. Remember, or arbitrage free price. So just like we did in the valuation of a forward or a future, right? The valuation for a FRA is simple and easy. You're getting my point? So Guram is asking about the previous example. Bank B will lend on the actual basis and recover or pay the differential amount on FRA. Okay. Or the second option is Bank B will lend at the FRA rate only without anything, without any need to pay the difference. Okay. There are both the options available. Now it depends how they want to settle. Okay. 5% is 9 months. No, it's 6 months. I have taken a FRA of 3 by 6. Satish, I have taken a FRA of 3 by 6. 3 by 6 means the duration is 3 months. It will start from 3 months today. Effectively, I'm talking about 6 months from now. So this is 0, third month, and 6 month. Okay. So 5%. I have assumed that it is for the 6 months interest rate. 4% is for the 3 months. And hence 5.94% is the theoretical minimum value. Understood till now? Now, let's assume in case 1, if let's say the FRA is available at lower than 5.94%. If let's say the FRA is available at any price, any percentage lower than 5.94, then what we will say? FRA is underpriced. Correct? Can we say that FRA is underpriced? Yes. What we need to do in case something is underpriced? Students, if something is underpriced, we can take a long position in FRA. Or can we say that borrow, correct? Through FRA. In my previous part, I have told you, right? Long position will be assumed for the person who is trying to borrow through FRA, right? Now, can we devise a strategy here? Yes, the strategy is 0, 3 month, 6 months. So, if let's say this has to be borrowed, correct? FRA of 3/6 has to be borrowed, correct? So that means 0 to 3 also I will borrow, and 0 to 6 months I will invest. So what is the strategy? I will invest for 6 months by borrowing today for 3 months, right? So at 0th day, what I will do, I will invest for 6 months. I will borrow for 3 months. Now, once the 3 months gets over, I have this FRA, which will also help me to borrow for another 3 months. Okay. So this borrowing will happen through FRA, for which I know the rate as on today. The moment you do that, the moment you do that, how will the gain or loss come? So let's say borrow one. This is borrowing one, this is borrowing two. Hear me out, students. Borrowing one for 3 months. Correct? Let's take an example of 1 lakh. So 1 lakh will become, let's say, 1 lakh 3,000. Let's assume 3,000 is the rate. Right? Now, here again, borrowing 2 will come. Borrowing 2 will be for FRA 3/6. So let's say that this 1 lakh 3,000 becomes 1 lakh 6,000 under FRA, right? So FRA also adds 3,000 of interest. And this 1 lakh which was got borrowed on day one is now invested for 6 months, right? Here after 6 months, let's say we get 1 lakh 7,000. So there is a net arbitrage gain of rupees 1,000. You're getting my point, students? So this 1,000 rupees gain has flown. Why? Because we have done the correct strategy while we saw that FRA is underpriced. FRA is underpriced by 5.94%. So we have taken a long position in FRA. That is borrowing through FRA. If we take a long position in FRA, borrowing in FRA, the first 3 months also need to be on a borrowing front, and for the entire period, we can invest. That is the strategy. Now, ultimately, whatever you end up paying after 6 months versus what you end up receiving after 6 months, there will be a gain of 1,000 rupees. Okay, this we can even prove through the actual interest rates also that we have taken above, students. Okay, now let's quickly cover the case 2 as well. So what is case 2? So this 1 lakh 7,000 and 1 lakh 6,000, students, I have assumed a hypothetical numbers, right? We can, again, I'm saying we can put the actual numbers also in my previous example and arrive at there will be a gain only. So case 2, where FRA is available at higher than 5.94%. 5.94 was our theoretical minimum value. Now, can we say that this is a overpriced FRA? Yes. What we do in case something is overpriced, we short sell that FRA. We do a short selling of that FRA. While doing a short selling of FRA, that means we have to invest through FRA. Now, if we have to invest through FRA, what will it mean? 0, 3, and 6 months. So here, if we are investing, so 0 to 3 months also we have to invest, students, by taking a borrowing of 6 months. So what you will do, you will borrow for 6 months as on today, and you will invest for 3 months. And also, as on today itself, you will also take a FRA, you will short sell a FRA of 3 by 6. Correct? So that once your investment gets matured after 3 months, again, you invest through that FRA what you have committed today. Okay, students. I hope this strategy is clear. Case 1 and case 2 is clear, students. What, so we have to just keep a very simple thing in mind. If there is a FRA which we have calculated the theoretical minimum price, if it is a higher value, that means we can short sell that FRA and devise our strategy in case 2 basis. If the value of that FRA is lesser than 5.94, then we can devise our strategy basis case 1. Okay. So Guram is asking, if borrowed money paying interest rate as per FRA and bank will collect the difference amount between current rate and FRA rate, what is the use? No, Guram, you're not able to understand, Guram. I'm repeating it for the third time. There are two ways to settle a derivative. There is a gross way, there is a net way. In case of a gross way, what happens? Either you will pay or receive the interest basis FRA. In this case, there is no need to pay any difference because you have committed to invest or borrow through the FRA rates, and you are end up paying those interest rates for the borrowing or receiving. In case you are settling it net, then what you will do? Pay or receive interest basis actual market interest, and at the same time, because you have entered into FRA, there is a need to pay or receive the difference on account of FRA. So there is a use of FRA. Guram, we cannot say that FRA, there is no use only. Please understand, if you are settling it basis gross, then you're ultimately paying or receiving the committed rate in FRA. Then there is no need to pay off any difference. And then you will ask that what is the benefit? The benefit is, if you have not entered into that commitment, you would have been exposed to the higher or the lower rate in the market. That's how we do for forwards. In case of net, since you are paying or receiving interest basis the actual market rate, the net settlement will not be complete until you pay off or receive the difference on account of FRA. Here, the ultimate impact on account of FRA will be your effective interest rate will become equal to the FRA rate that we have calculated. So this is what I've used in my example. Okay, Guram, I hope now it is clear. Okay, students. So the valuation of FRA we have covered, students. Now we will have to move to the interest rate futures. So students, interest rate futures, which are also called as IRFs. So forward rate agreements is as good as your forward derivatives that we have studied in derivatives. And interest rate futures is as good as your futures concept that we have discussed in derivatives. Now, the difference between forwards and future, students, you would have already known is that forwards are over the counter contracts, which are having a very specific terms, which have a very specific conditions to those parties. However, the interest rate futures are actually the standard contracts that are available in the stock market for the people to, or let's say for the investors or for the borrowers to enter and execute. Now, the interest rate futures are actually denoted in terms of the bonds price. And we already know, basis our understanding from the bonds valuation, that the bonds price is inversely related to the interest rate changes. Correct? If interest rate moves up, the bond price moves down. If the interest rate moves down, the bond price moves up. Okay. So the bonds price is inversely related to the interest rate changes. And hence, we are making use of this relationship to enter into a interest rate future. Interest rate if it moves up, or interest rate if it moves down. What will happen to bonds price, students? Bonds price will also move down. Okay. Here the bonds price will move up. Okay. So in a way, what I'm trying to say is that market is not having anything called as FRA equivalent futures. It always have bonds futures. So what we do is we use those bonds futures to hedge against the interest rate movements. How we can do that? If there is an expectation that the interest rate will go up, if there is an expectation that the interest rate will go up, in that case, I have to devise a strategy by which I will gain, right? I have to devise a strategy by which I will have to gain. How I will gain? If the bonds price goes down, then I will gain, right? Because the moment interest rate goes up, the bonds price will go down. So what I have to do with bonds? In that case, I have to do a short selling of bond. And here interest rate is, there is a risk of interest rate going down and I have to hedge against that risk. That means I have to purchase the bonds. Okay, students. So this is how we do the bonds, short selling or long position to help achieve the interest rate risk management. We will understand it through the help of one question. So let's do one thing, students. Let's take break of 10 minutes first. Then we will go to the questions. Okay. So it's 8:27 now. We will again reconvene at 8:37. Okay. Back. So before going to the break, we were discussing about the interest rate futures. And here we said that interest rate futures are more importantly related to the bonds price movements. And since bonds price are inversely related to the interest rate changes, higher interest rate risk, the risk of interest rate being going to higher will be secured by short selling the bonds. Okay. By means short selling the bonds futures. I need to specify the futures here. Okay. Okay. Guram, please let me know whether you are clear now or not for the FRA between the difference and all. I hope this understanding gives better clarity, right? So interest rate futures is this. Sorry. Now let's move to question number 2. Okay. Question number 2 says Electra Space is a consumer electronics wholesaler. Okay, Guram. Thank you. The business of the firm is highly seasonal in nature. In 6 months of a year, the firm has a huge cash deposits, and especially near Christmas time and other 6 months, firm is in cash crunch, leading to borrowing of money to cover up for its exposures for running the business. See now, the way this question has been drafted, it says that 6 months of a year, it's a seasonal business. So whenever the season hits and there are good sales happenings, the cash flow becomes high and hence there are huge cash deposits that the company is sitting on to. However, the next 6 months, when there is a downtime of the business, then there is a need to borrow. Now, it is expected that the firm shall borrow a sum of euro 50 million for the entire period of slack season in about 3 months. So what they're saying is in about 3 months, the slack season is going to come. Since it is going to come, they are expecting to borrow 50 million. Now, what is the FRA quote here, students? What is the right FRA quote? What is the duration of slack season? 6 months. When the slack season will start? After 3 months from now. So FRA 3/9 is the right period. FRA 3/9 is the right notation for this slack season. Perfect. Yes, Satish, you are right. 3/9 is the right quotation for this FRA. Now, the bank has given following quotations. So they have given a spot price. Now, for these two rates, students, you would always understand that if you have to borrow, you will borrow at a higher rate. If you have to invest, you will invest at a lower rate. Correct? That's the significance of these two quotes. Even in the foreign exchange, you would have studied, students. If you want to buy a foreign exchange from the bank, you will end up paying the higher rate. If you have to sell the foreign exchange to the bank, you will end up selling at a lower rate in this quotation, right? And the difference was called as spread. Now, here, tell me for this situation, what is the relevant FRA? We have already understood it is 3/9. And in this case, you have to borrow through FRA or invest through FRA. Or in other words, I have to take a long position in FRA or a short position in FRA. I have to take a long position in FRA because I'm talking about slack season. And slack season is when I need to borrow. Correct? That the question is specified. So I have a relevant rate of 5.94%. Correct? Because I will borrow at 3 by 9 FRA at the rate of 5.94 percentage, students. Agreed? So this analysis is clear. Now, 3 months, Euro 50,000 future contract maturing in a period of 3 months is quoted at 94.15. If you see, students, 100 minus 94.15 is equal to 5.85. So there are two ways to represent a bond's future. One, you can represent this value, or even if you represent the percentage, so we can arrive at the other value. Okay, there is a relationship that we can quote. Now, you are required to determine how a FRA shall be useful if the actual interest rate after 3 months turns out to be 4.5 or 6.5. Second is how 3 months futures contract shall be useful for a company if the interest rate turns out to be mentioned is part A above. So the first part, they are saying that you have to calculate the impact because of interest forward rate agreement. Second part, they are saying that you have to calculate the impact on account of the futures contract. Simple. The question is simple and easy, students. So let's start with the first part first, right? We understand from what it is given in the question 0 to 3 months, then 3 months to 9 months, duration is equal to 6 months, right? Duration is equal to 6 months. So this is a FRA of 3 by 9, correct? This is a FRA of 3 by 9. And here we are saying there are different possibilities, 4.5 percentage or 6.5 percentage. So, basis facts that are given in the question, Electrospace needs to borrow Euro 50 million through FRA 3 by 9 at the rate 5.94. Basis facts given in the question. Electrospace needs to borrow 50 million through FRA 3 by 9 at the rate of 5.94%. Okay, understood? So we have understood that basis the facts that are given in the question, what should be the strategy for FRA for this company? Correct? Now let's calculate the gain or loss for the two different rates that are given that existed after 3 months. Now next part is the calculation of gain slash loss. Right. So we have been given two different rates. One is 4.5%, second is 6.5%. So we have done a purchase of FRA, right? The rate at which we have purchased is 5.94 and 5.94. So here in first place, there is a loss of 1.44%, right? Which is 5.94% minus 4.5%. There is a loss of 1.44%. In the second case, there is a gain, right? Because the interest rate has moved up. So 6.5% minus 5.94%, there will be a gain. Gain of how much? 0.56 percentage gain. And here there is a loss. So FRA payment becomes how much? 1.44% multiplied by euro of 50 million for a duration of 6 by 12. Okay. So this is 3,60,000 negative. Here I have not done present value. If you want, you can do the present value of this 3,60,000 also. Okay. Then the next part is 0.56 percentage, which is the gain on 50 million euro for 6 by 12. Yes, Prashant, you are right. 5.94 long position is what we have to take. So here the amount comes as 1,40,000. And this is a gain. So I have not included it on the negative side. Okay. Then finally the interest payment on euro 50 million borrowings will be how much? Now, again, Gurram, if you see here, we have calculated the difference first with the FRA. Now the interest payment will be basis the actual payment, correct? So this becomes how much? 4.5% on 50 million euro for 6 months. Similarly, here it is 6.5% on 50 million for 6 months. So it becomes 112,512. Sorry, it is 1,12,000. No, 11,25,000. 25,000, and here it becomes 16,25,000. So 1125 plus loss, right? Because this is a cost and this is a cost. So 1125 plus 3,60,000, the amount comes as 14,85,000. Similarly, here 16,25,000 minus 1,40,000 of the gain. So this also becomes 14,85,000. So by entering into FRA, the rate of 5.94% is committed. So here it becomes 14,85,000 divided by 50 million euros, right? Into 100 into 12 by 6. So the annualized rate becomes as 5.94 percentage. Okay, students. So in a way, the interest cost is logged at 5.94 percentage. Whether it goes up or down after 3 months, it is not impacting the numbers. Students, one more thing. If you see in our previous question, here I've mentioned here why it was not exactly coming out to 9.1%. But in the current question, it is exactly coming out to 5.94%. Right. Similarly, here there was a case one also. It was 9.10928. It was again not exact 9.1. Right. So what I'm trying to say is that in question number one, why our effective interest rate was not equal to the FRA rate. However, in question number two, it is exactly equal to the FRA rate, 5.94. Why it is happening, students? Have you noticed anything that I have changed in the way of calculation from there to here? Come on, students, tell me. This is a small observation, but very important thing. So the question is, in question number 1, our effective rate of interest was not coming as equal to the FRA rate. But in question number 2, exactly it is coming out to the same FRA rate. The question is why? Should I say, or anyone have some thoughts here? Very nice. Satish Kumar, you are right, Satish. So there is only one change. The way this question has been handled is, in this case, I have not taken the present value of this gain or loss, right? Hence, our answer is coming exactly same. In the previous question, we have taken the present value of this gain or loss, and hence there was a slight difference in the committed rate and the effective rate of interest. Okay. Yes, Gurram, very good. You're right, Gurram. We are not bringing the present value. True. Thanks, Gurram and Satish, for your answers. Now, students, coming to the second part. First part is done. Second part of this question is related to futures. Now, let us understand, students, there is a borrowing and there is a futures, right? So, there is a borrowing need of 6 months. However, the futures are available for 3 months. Futures are available for 3 months. So, in your regular concept of hedging, what we do, if let's say the period is not same, we will divide or multiply to make it as same. So whatever are the regular number of future students, we have to multiply it with 2. Correct? So as to achieve a complete hedge for 6 months. Correct? So for hedging 6 months, futures have to be multiplied by 2x. Okay? Here it is 4.5%. Here it is 6.5%. There are two different cases. One, if we have to sell futures, how much futures we will be selling? Sorry, at what rate we will be selling the futures? The same is given in the question, right? 94.15. 94.15, we will sell the futures. And why are we selling the futures? Because we have to hedge against the interest rate going up. If we have to hedge against the interest rate going up, we have to sell the bonds future, so that if the interest rate goes up, the bonds prices will go down. The moment bond prices will go down, I will gain. And with that gain, I will make it up for the interest rate increase losses. Okay. So Suchishmita Sen is also saying taking time value of money is mandatory. Okay. No, see, if let's say the question is saying that the time value, if we have to calculate the gain or loss, so we can restrict our calculation to that. Okay. So the correct way is taking the time value of money, because ultimately the gain or loss is settled by the date at which we are starting our duration. Okay. So both the ways are okay. If you want to take, if you don't want to take, it is okay. Yes, so Prashant is also asking the same part, whether when to take the present value or when not to take. It is okay to take the present value if the question is only asking about the gain or loss, right? But in this kind of a question, where we have to prove that what is the ultimate impact of the FRA, then in that case, better not to take, students. Okay. Now the number of contracts. So we have to sell futures. Number of contracts to be sold will be how much? 50 million euros is the amount. 50,000 is the lot size for the bonds futures. And any which ways, I am saying that we have to do a 2 into 2, which is into 6 months for hedging divided by 3 months for availability of futures, right? So this gives us 2,000 contracts. Now the second part is price of these futures at the start of the contract will be how much? Now, if let's say the interest rate is 4.5%, then it will become 95.50. How? 100 minus 4.5. Sorry. Similarly, if the interest rate moves to 6.5%, so then it will become 93.50, which is again 100 minus 6.5. Correct? So, third part will be gain slash loss. So students, please note that we have sold the futures. Now, if we have short sold the futures, any price increase will give me a loss. We have sold the futures at 94.15. Correct? We will purchase back our futures at 95.5, which is 3 months from now. So that means there is a loss. 1.35, there is a loss. 5.85 minus 4.5. Yes, 1.35, there is a loss. Similarly, here there is a gain. Gain of how much? 94.15 minus 93.50, which is 0.65. There is a gain, students, here, right? Now, what will be the cash settlement on futures? So 1.35 is the loss. 2,000 were the number of contracts. 50,000 euro was one lot size. And this will happen for 3 months, students. Correct? Because 1.35 is the annualized loss. So 1.35 into 3 by 12, which is the duration of that future. So this will become as 3,37,500 as loss. Here it will become how much? The gain. I'm putting it here. 0.65 into 2,000 were the contracts into 50,000 into 3 by 12. So this happens 1,62,500 as gain. Okay. Okay. Then this is a loss and this is a gain on the futures contract. Now, finally, our interest on borrowing. Interest on our basic borrowing was how much? It was 11,25,000 here and 16,25,000 here. Correct? Because if it is 4.5, then it was 11,25,000 that we have already calculated above, right? So this gives us how much? 14,62,500. And here gain will be reduced, right? So this 1,62,500 will be reduced from 16,25,000. So this becomes 14,62,500. 14,62,500.9, 16,25,000. Yes. Okay. So just to be precise, what I've done is 11,25,000 plus 3,37,500, and here it is 16,25,000 minus 1,62,500. So here the effective percentage becomes 14,62,500 divided by 50 million euros into 12 by 6. Correct? Because again, this is the borrowing cost for 6 months. So on an annualized basis, it becomes 5.85 percentage. And this is the same rate, students, right? At which we have futures operating. Correct? So effectively, again, here we have locked the prices or we have locked the interest rate at 5.85. Even if it goes to 6.5, still we will be end up paying on 5.85 as the interest cost, students. I hope this is clear, students. Okay, clear. So this question is done. Now hear me out. Derivatives, derivatives, and here we are talking about interest rate risk management. So derivatives, we have forwards, correct? So the equivalent of that here becomes forward rate agreements, right? Similarly, in derivatives, we also studied about futures. So the equivalent of here, it becomes interest rate futures, interest rate futures. And these are bonds led, bonds prices led, correct? We said that bonds prices, we will find out the inverse proportion and hence we will achieve that. Then finally, we also had options in our derivatives. Here we call as interest rate options slash guarantee. If you see in the first part of the session, I said there are modern methods, there are traditional methods. Traditional methods, we discussed about ALM, we discussed about FRA, which is forward rate agreement. In the modern methods, there was interest rate futures, which we have again discussed. And now we are going to discuss about the interest rate guarantee, which is the interest rate options, right? Whichever way you want to call it is same. So let's come to the fourth technique, interest rate options, or we also call it as interest rate guarantee. Okay. Now, till now, students, if you see the very likely difference, what we had of forwards futures with options is same for interest rate options. What was the difference between options? In option, there is no commitment. There is a right, right? There was a right wherein if the situations go wrong, then the holder of that option can exercise the right and make good those losses. Okay. So similarly here also, interest rate options or guarantee as an instrument is a right, but not an obligation. Okay. It can be exercised under favorable conditions, right? That is where we called it as in the money, out of the money, at the money. You remember all the payoffs we discussed. So the same thing. And it need not be exercised for, need not be exercised for unfavorable conditions. Okay. And how we can understand this is in a very simple term. Let's say A, again, I am restoring back to that previous thing. Let's say A is a financial contract, right? So we were saying that this is a right, correct? Or this is a privilege, but this is not an obligation, not an obligation. Now, what exactly it's a contract? What exactly there is a right to borrow. Okay, a specified amount, which is again a notional amount in this case, right? At specified interest rate. So they will borrow a specified amount at a specified interest rate on a specified date. This is called as cap option. In the derivatives, we used to call it as call option, right? Here it is called as cap option because ultimately we are capping the interest cost, right? Because here we are getting a right to borrow at a specified interest rate. Now, if tomorrow the interest rate moves higher than that interest rate which is specified here, then we will exercise this option and ultimately we will end up paying whatever has been specified as the interest rate there. Yes, Satish. For interest rate futures, there is a margin money requirement because it is happening on a stock exchange and it happens through bond futures. So, bonds futures, whatever are subject to those margin requirements, will be subject to this as well. Okay. So, for cap option, again, there is a buyer and there is a seller. Okay. Understood? So, this is a cap option. B, we call it as floor option. So which guarantees you a minimum floor return. That is called as floor option. Okay, now we will understand this. A is again, let's say a contract, is a right, it's a privilege, but not an obligation. To do what? To invest or to lend. Again, a specified amount for a specified interest rate on a specified date. This is called as floor option. Okay. This is called as floor option. So in this case, let's say the contract says the amount to be invested is 1 crore. Sorry, at the rate of 18% per annum. This is the option that has been given. On a specified date means, let's say 1 year from today. Okay. So 1 year from today, I have a right to invest 1 crore rupees at the rate of 18% per annum. Now, after 1 year, the actual rate turns out to be, let's say, 20%. So will I exercise this option? No, I will not exercise the option. I will just straight away go to the market, invest it at 20% because I'm getting a higher return. But what happens if the market interest rate goes down below 18% after 1 year? Then I will exercise this option. Correct, students? So in a way, for floor option also, there is a holder, there is a buyer, which we also, so holder is also called as buyer. And here there is a seller, or we also call it as borrower, right? Because ultimately, this guy who is selling the right to invest will have to borrow later on, correct? And the premium in case of both cap or floor will be paid by the buyer. In cap, it will be borrower. And in case of floor, this person will be investor, correct? And it is received by seller. In case of cap, who is the seller? The person who wants to invest. And in floor, who will become the seller? The borrower. Okay. Clear, students? Now, at last, let's also discuss about the payoffs for buyer and for buyer and seller of cap and floor options. Okay. Let's write it down. Cap option, floor option. So the holder slash buyer is having a right to borrow here, and here he's having a right to invest. So this will happen at, let's say, 10% here, again 10% here. So this is called as cap rate. This is also called as floor rate. Okay. This is called as strike price. This is also called as strike price. So the strike price is 10%. Okay. Now let's take a example. Let's take a case where the actual interest rate is, let's say, 12%. So in such a case, under the cap option, it will become in the money now, correct? Because the right to borrow was at 10% and the market has moved to 12. So the person who has this right is actually a right for 2%, right? Because there will be a gain now. So gain slash loss in options. So 2% gain will be there. And here it will be 0% because for a person who wants to invest, if he has a right to invest at 10%, but the market is giving 12%, what he will do with that right? Nothing. Under that option, there is 0% gain or loss. Correct? Because he will just go in the open market and invest at 12%. Second case, where we have actual interest at, let's say, 88%. In such a case, under the cap option, the holder or buyer has a right to borrow at 10%, but the market is already at 8%. So do you feel that he or she will borrow? No. He or she will go in the open market and borrow from the open market. So that comes out to gain or loss of nil. In the second case, talking about the floor options, the person has a right to invest at 10%. The market is giving only 8%. So do you think that person will exercise the right to invest at 10%? Yes. Because under this option, he or she is getting 2% more. So there is a 2% gain here. Okay. There is one more piece of information here, which is, let's say, premium. So for giving this call option to a holder or buyer, the seller of this cap option, not call, sorry, cap option will charge a premium. How premium will be charged? Let's say 1%. Here also it's, let's say, 1%. Okay. So the net gain or loss will become 2 minus 1%. You're getting my point, students? So if you have to really calculate the net cash flow or inflow, then it becomes the 1%, which is minus the premium. Prashant is asking seller borrower means where it is. I have mentioned seller or borrower here. So seller of floor option, here it means seller of floor option, and ultimately he will become the borrower, right? He will be in the position of borrower because he is selling the right to invest. If the person exercises his right to invest, he has to borrow. Okay. Clear, students, still here? Sorry. Sorry. Yes, I was muted. Sorry. Sorry, guys. So I said that let's come to question number three, students. Okay. In question number three, the what we started our discussion is that XYZ Limited borrows bonds 15 million for 6 months LIBOR plus 10%. So what I was explaining students is that this 15 million bonds LIBOR as a matrix is now replaced by SOFR, which is secured overnight financing rate. Okay. And this is just a index rate. Okay. This is just a, like we have discussed about MIBOR, right? Mumbai Interbank Offered Rate. So it is just a rate that happens um within that market. Okay. So XYZ Limited borrows bonds 15 million of 6 months SOFR, you can read, or LIBOR you can read, whichever way, plus 10% for a period of 24 months. The company anticipates a rise in LIBOR, hence it proposes to buy a cap option. Now see students, the company is in a borrowing side and they are entering into the cap option, which is perfectly fine because the rate of interest is expected to go up from its bankers at the strike rate of 8%. So the LIBOR will get, compared to this 8% because the strike rate is 8%. The lump sum premium is 1% for the entire reset periods and the fixed rate of interest is 7% per annum, which is fine. The actual position of LIBOR during the forthcoming reset period is as under 9, 9.5, and 10. So they have given us the actual movement of this LIBOR also. You are required to show how far the interest rate risk is hedged through the cap option. So they have given us that there is a cap option that has been already entered into, right? Now, using that cap option and using these actual things that are happening in the different reset periods, we have to tell them how much it is, hedged. For calculation, work out figures at each stage up to 4 decimal points and amount nearest to points. It should be part of the working notes. So students, if we quickly see what is the amount required, amount required is 15 million pounds. Okay. Amount required is 15 million pounds. So the cap option is 8% against LIBOR, correct? That is given. And we are assuming that there are 4 reset periods, okay, of 6 months each, correct? So let's say we are standing at 0, first reset period, second reset period, third reset period, and fourth reset period. Okay. What was the premium? Premium was 1%, right? Yes, 1% for the entire reset periods. Now, students, if you see total premium will be how much? 15 million into 1%. So it becomes 1,50,000, right? 1,50,000 premium. Now, this has a value as on today. Can we find out what will be the equalized equalized annuity amount, not annuity but semi annuity amount for this 1,50,000 going forward for the 4 reset periods? Reason being, for comparing at each and every reset period and to calculate the effective amount paid or given, we will have to compute this 1,50,000 broken into four different numbers. Can we do that? Yes, we can do that. Just look here, students. It's a very simple calculation. 1,50,000 will be equal to X divided by 1 plus 7% is the rate of interest, right? Raised to the power 1. Plus, for the second reset period, which is 1 year from now, it will be 1 plus 7% divided by 2 raised to the power 2. Correct? For the third reset period, this will be 1 plus 7% divided by 2 raised to the power 3 plus x divided by 1 plus 7% divided by 2 raised to the power 4. Okay. If you see this and calculate the value of x, it becomes 4861. So this is a equalized annuity amount kind of a number, right? 40,861 pounds for four different reset periods of 6 months each. If they are taken to the present value as on today, it will be 1,50,000. Understood, students, till now? Okay. Why we have calculated this? Because then only we will be able to arrive at what is the real cash outflow or inflow at the end of these reset periods. Okay. Now, students, calculation of net payoffs. Let's talk about the reset periods that has been given. This is the LIBOR. This is going to be the cap rate. This is going to be the difference from bank, right? And this is the premium that we have already paid to the bank and hence the net payoff. Clear, students? Let's go one by one. Reset period first. What is the LIBOR appearing on the first reset period? 9%. So 9% is the amount of LIBOR, right? What is the cap rate? Cap rate is 8%. Correct? So the difference from bank becomes 1% multiplied by 15 million into 6 by 12. Correct? Because 6 months is the reset period. 1% is the differential. So bank will pay us the moment LIBOR increases from 8% and above, bank will pay us the differential. So this amount comes as 75,000. The premium equivalent amount for this reset period is 40,861. This will be reduced from the actual receipt. It will become 34,139. Why we divide by 2? Where are we? Because 7% is the per annum rate. Reset period is 6 months. How we know reset period is 6 months? Because he's XYZ Limited is borrowing for 24 months. Correct? If they are borrowing for 24 months and we have assumed reset periods to be 4, that means 6 months is the reset period. Okay? Which because 24 divided by 4. And hence we have divided it by 2, students. So the first is clear. Let's move to the second reset period, students. In the second reset period, what is the LIBOR now? 9.5%. Cap rate was 8%. Still, are we beneficial from this cap? Yes. It is still in the money. 1.5% multiplied by 15 million into 6 by 12, which is equal to 25, uh, 83, 1,03,000. Yeah, so it will be 1,12,500. Correct? 4861 will still continue as a amount. So the net amount comes as 71,639. Then the third reset period, students, is how much? It's 10%. Again, it's still in the money. It is going better and better, right? Now, 2% on 15 million for 6 by 12 comes around 1,50,000. 4861 will get reduced, and ultimately we will have 109,139. Okay. So the net payoffs for these three different reset periods are this, and this. Let me see if there is hedged, right? So to this extent, their interest rate risk is hedged, right? Because they are getting these payoffs from the banks, right? So if we just do a total here, it comes as 214,917. Correct? Sorry. So the extent, sorry, by which interest option have been hedged, but interest option have hedged the risk is 0.214917. So, Suchismita, you can do at the beginning also or at the end also. As I told you, if you do at the beginning, you will have to take the present value, right? And if you do at the end, then in that case, there is no present value needed to be taken. Okay. Both ways, it will be absolutely fine. Let's move to the next question, students. I hope this is understood clear. Now we have a practical question that we discussed on the cap option, right? So we have discussed forward rate agreement, interest rate futures through bonds, futures, and then interest rate options or interest rate guarantee. Okay. Now let's come to the question number 4. Two companies, ABC Limited and XYZ Limited, approach the DEF Bank for FRA forward rate agreement. They want to borrow a sum of rupees 100 crores after 2 years for a period of 1 year. Bank has calculated the yield curve of both the companies. Now, students, first of all, let us denote this FRA. Come on, students, tell me, how will you denote this FRA? Period is 1 year, but it has to be borrowed after 2 years. How will you denote this? FRA dash into dash. Tell me. Come on, students, tell me. How will you denote the FRA? So this will be a denotion of FRA. Perfect. Satish, you are right. Kusuma, you are also right. Prashant, you are also right. Very good. You can write it as 2 by 3 also, or 24 by 36 is also completely fine. Okay. I will be taking 2 by 3. Okay. And they have given us the yield curve year 1, 2, and 3. These are the interest rates for these two different companies, XYZ and ABC Limited. Now, the difference in the yield curve is due to the lower credit rating of ABC. If the credit rating is lower, as I said, if the credit rating is lower, that means risk is high. If the risk is high, the interest rate will also be higher. Correct? So that is why if you see everywhere, the interest rates are higher. You are required to calculate the rate of interest DEF Bank would quote under 2 by 3 FRA using the company's yield information as quoted above. So they're asking us to calculate the rate of interest that will be quoted, okay, by DEF Bank to both of these companies. Can we calculate that? Yes, we already know how to calculate the valuation of an FRA, right? How to value a FRA, that we know. Second part, suppose the bank offers an interest rate guarantee for a premium of 0.1% of the amount of loan. You are required to calculate the interest payable by XYZ Limited if the interest rate in 2 years turns out to be 4.5 or 5.5. The second part is related to the interest rate guarantee. Okay, the first part is what is related to the calculation of the rate of interest that has to be offered to both the companies. So let's first start. So this is students FRA of 2 by 3, 0, 2 years, third year, duration is equal to 1 year, correct? So for calculating the FRA valuation, we need to know what is the 2 year rate and what is the 3 year rate. 3 year rate is also given and 2 year rate is also given. Then accordingly we can calculate, okay? For XYZ Limited company, the FRA will be valued as, what is the 3 year rate, students? 4.48 raised to the power 3 is equal to, what is the 2 years rate, students? 4.2% raised to the power 2 multiplied by 1 plus x percentage raised to the power 1. Understood? This equation is understood, students? Okay. If we solve this, x comes out to be 5.04 percentage. So what do you think? How much will bank quote? Bank will quote a FRA at 5.04 percentage for 2 by 3. Correct? So FRA 2 by 3, the bank will quote as 5.04 percentage. This is for XYZ company. Similarly, can we do it for ABC Limited? For ABC Limited, the interest rates are a bit higher because the question has itself mentioned they have a poor credit rating. For ABC Limited, how much will it be? 5.78 and 5.48. This is for 3 is equal to 1 plus 5.48 percentage raised to the power 2 multiplied by 1 plus x percentage raised to the power 1. Okay. So this becomes this much, then x percentage is equal to 6.38 percentage. So FRA 2 by 3 will be quoted as 6.38 percentage. This is for ABC Limited. Okay, and this was for XYZ Limited. Okay, now I hope this is clear. Okay, I'll just be pausing here for 15-20 seconds. Yes, now the second part, it says that suppose bank offers interest rate guarantee for a premium of 0.1% of the amount of loan. You are required to calculate the interest payable by XYZ Limited if the interest rate in 2 years turns out to be. So first of all, at what rate the bank will offer a guarantee to XYZ? Just now we have calculated, students. It will offer a interest rate guarantee at 5.04 percentage, correct? And it will charge a premium of how much? 0.1%. Okay, which is fine. You are required to calculate the interest payable by XYZ Limited if the interest rate turns higher or lower. Simple. So the second part, we understand that the cap rate, first of all, is determined to be 5.04%. Premium is 0.1%. And the notional amount is equal to 100 crores. And this we are talking from the point of view of XYZ Limited, correct? Because that is what is needed also in the question, right? So we have been given 4.5 and 5.5. There are two cases that has been given to us, right? So the interest payment will happen on the actuals, right? Here also 5.5 percentage into 100 crores into 1 year. Okay. So here it becomes 4.5 crores. Here it becomes, see here, what will happen? In case I have obtained a interest rate cap option at 5.04, in case, okay, now first of all, what is the cap option? Cap option gives me a right to borrow at 5.04%. In this case, students, if the interest rate moves down to 4.5%, this right is not a right anymore for me, right? Because now I can just go and borrow in the open market at 4.5 percentage. So I will end up paying 4.5 percentage plus premium of 0.1% on this. But in case of the interest rate is moving up to 5.5 percentage, then students, I will actually not pay 5.5. Correct? Because I already have a right to borrow at 5.04 percentage. So I will end up paying 5.04 percentage on 100 crore for 1 year. So this is equal to 5.04 crores. Apart from this, in both the cases, I will end up paying premium. However, in the first case, the option is not exercisable, but still I have to pay premium. Premium is a sunk cost. I cannot avoid that because that is when the liability will be assumed by the person who is selling that option. Okay. What is the premium? 0.1 percentage on 100 crores. Correct? 100 into 0.1 percentage. So this is 0.1 CR. This is also 0.1 CR. So the total becomes 4.6 crores in this case, and here it is 5.14 crores. Clear, students? So this is a good question even on the valuation of a FRA plus its linkage to the interest rate, cap options, right? So let's move to question number 5, students. Now see, TMC Holding Limited has a portfolio of shares of diversified company valued at 400 crores. Currently, they are having a value of portfolio with them of 400 crores. Enters into a swap arrangement. Okay, this is a question on swap. Okay, before introducing to you the concept of swap, let's just try to attempt this question. Okay, so that you will get to know how the question goes for a swap. Okay, swap, I will take it up in the next session to tell you about the exact way how it is derived. But in this case, it is very easy. Let us take it through. So, valued at 400 crore enters into a swap arrangement with non-bank on the terms that it will get. So, TMC Holdings will get 1.15 percentage on 80 crore. So that means on even 400 crores also 1.15 is what it will get, right? 1.15 percentage on 400 crores also the same number it will get, right? Because principal or notional, how much you can increase or decrease, that is okay. Of crore in exchange of return on portfolio, which is exactly tracking the Sensex, which is presently 21,600. So get 1.15 and pay whatever return basis Sensex you are earning. Okay. So I will get 1.15 fixed on 400 crore, but I will have to pay whatever I am earning as a return. Okay. Calculate the net payment to be received paid at the end of the each quarter if the Sensex turns out to be these different values 1, 2, 3, 4. There are 4 different quarters that are given. Simple. So we have to just calculate the first receipts and payments and then calculate the net payoffs. It is very easy, students. So let's talk about quarters 0, 1, 2, 3, and 4. What is the Sensex value, students? Just focus here. 21,600 is the first value, students. Then the next value is 21,860. It has increased. Then 21,780. It has gone down. In the third quarter, it has 22,080. It has again moved up. And in the last quarter, it has again gone down. Can we calculate what is the Sensex returns? Simple. Current value minus previous value divided by the previous value. Correct? So 21,860 minus 21,600 divided by 21,600. So this is 1.2037 percentage. Is it understood how we have calculated this? 21,860 minus 21,600 whole divided by 21,600. This is how this has been calculated. In the next quarter, there is a loss now, right? 0.3660 percentage. Correct? In the next quarter, there is a loss, students, because it has gone down. The Sensex returns has gone down. In the third quarter, again, the Sensex returns has gone up. It has gone up. Hence, the gain is 1.3774 percentage. And in the last quarter, which is the fourth quarter, there is again a loss of 0.5435 percentage. Okay. Can we know now what is the amount payable? Yes. Whatever is the gain or loss, that is the amount payable or receivable, right? in the first case. And how we have to calculate? 400 crore is the value of portfolio multiplied by percentage that we have arrived. So 400 crore multiplied by 1.2037 comes out to be, okay, wait, let me just remove this. Yes, so this becomes 4.8148. Okay. How this has been calculated? 400 crores multiplied by 1.2037 percentage. Okay. Similarly, the next value has been calculated accordingly, 1.4640, 5.5096, and lastly minus 2.1740. Clear, students? This is the amount payable. Okay, this is the amount payable. Now the fixed return, we will get how much? This is fixed actually, right? In the 0th period, it will be 0. And how much it will be? As I said, 1.15 percentage into 400 crores. This is the fixed return that it will get. This is how much? 4.6 crores. Correct? So 4.60, 4.60, 4.60, and 4.60. So the net amount will be, so in the first quarter, receive 4.6, pay 4.8418. Then ultimately we are negative of 0.2148, right? In the next quarter, receive 4.6 and also receive 1.4640. So there is a double gain. It will be 6.0640. Okay. In this, I will add 4.6, I will add 1.4640. Okay. In the third place, I will pay 5.5096. I will receive 4.6. So that means there is a net loss 0.9096. And in the last place, again, there is a gain because I have incurred a loss on Sensex and I will also recover 4.6. Okay. So net, there is a gain of 6.7740. Okay, students. I hope this was easier without even understanding the knowledge on swap. We just followed what was mentioned in the question and tried to calculate what will be the payment that this TMC Corp, right? TMC Holdings will be doing, and what will the receipts that this TMC Holdings will be again doing. Okay, the reason being this returns of the Sensex is indexed to how the Sensex moves. Correct? Hence, we have to just first calculate what is the return in the Sensex, right? That we can easily calculate between the closing value minus the opening value divided by the opening value, right? This is how we calculate the movement. And that we can just simply multiply with the amount payable. Now, students, the catch here is in the second and the fourth quarter, wherein we have incurred a loss. Since we have incurred a loss, the bank will make good that loss also to us. Because if you see, that is what the arrangement with the bank. We will exchange the return of portfolio with the 1.15 payment on the notional amount. Okay. So I hope this is clear, students. Accordingly, we have calculated the net amount too in this case. Just to recap, what all things we have covered in today's session, students, right? So we started our discussion with the interest rate risk management topic, wherein we said that there are two primary reasons for paying any interest. One is definitely the risk of non-payment of interest or principal both. And second is the inflation or time value of money. Now, since interest rate as an index is bound to change through market operations as well as through RBI interventions, there is a risk. The risk on financial statements for a higher or lower finance income or finance cost, right? To avoid those risks, we have developed some of the techniques. What are they? The techniques were classified into traditional method and modern method. Now, traditional method, we had a ALM, asset and liability management method, wherein we said that the maturity profiles of assets and liabilities has to be matched. Similarly, on forward rate agreements, FRAs, we said that if today we want to borrow, not today, but 1 month, 2 month, 1 year from now, which is at a later stage for a duration of some time, then how our position will look like. We also discussed about the valuation of these FRAs, how we will be valuing those FRAs. If we have the full period interest rate and we have the starting period from now till starting period interest rate, we can arrive at the FRA for the differential period. Very simple calculation on forward rate agreement, right? Then we discussed about the interest rate futures, where we said that interest rate futures are to be utilized from the bonds pricing, because bonds are inversely proportional to the interest rates. We will use this relationship to build upon our strategy. So if we have to hedge against the interest rate going up, we have to hedge against the bond future prices going down. Okay. Similarly, then we discussed about the interest rate guarantees, where we said that interest rate guarantees is as good as options, right? Where there is a right, there is a privilege, it's not an obligation, there is a premium involved, and hence we have solved some of the questions. So next session, students, we will start our discussion with swaps and we will cover the balance part of the questions. Then our interest rate risk management topic will be clear. So thanks a lot, students, for your patience listening. Please do revise the concepts well. And in the next session, we will be continuing with the same topic. Thank you. Thank you, everyone. Thank you.